My name is Gareth Kelly. I'm Financial Controller here in O'Dwyer's, and I'm delighted you could join us for a monthly client information talk. Today's briefing is interpreting financial reports and audits, something I find quite interesting, and hopefully everyone else will too. Our talk today has been given by Dave Spicer. He's from ECOVIS BBT. Dave is ECOVIS BBT's Audit Compliance Principal and Financial Reporting Specialist. So Dave's been with ECOVIS since February 2009. Prior to that, he was with KPMG, working in both Ireland and Finland. Primarily in Helsinki, Dave worked on due diligence and selling domestic and cross-border private equity-backed transactions, and in the Dublin office working in the assurance practice and transaction evaluation projects. So Dave's an associate member of both the Institute of Chartered Accountants and the Irish Taxation Institution. So the presentation will be about half an hour or so, and there'll be time at the end for some questions. So just hand over to Dave now. Thanks.
Thanks, Gareth, for the kind introduction. As Gareth mentioned, my name is Dave Spicer, and I'm a Director and Head of Audit Compliance with ECOVIS BBT. And I'm here today in my capacity as an auditor of a good number of OMCs to speak about the audit process for OMCs and interpreting OMC financial statements. And I suppose by OMCs we mean owner management companies. So that's just a little bit of background on me. I think Gareth pretty much summed it up quite succinctly there. Just some qualifications, industry experience, and main areas of interest. So the agenda for today, we're going to break the topic into three distinct sections. Firstly, we'll look at audit requirements for directors. Then we'll get into understanding the audit process. And finally, we'll have a look at reading financial reports. I'm going to keep it relatively uncomplicated and at a reasonably high level, because I'm conscious that everybody in the room here, and indeed people online, not everybody is an accountant. So it'll be kind of fairly basic, and my apologies to the accountants in the room if it is a bit basic for you. So we'll kick it off, and we look straight away at directors' responsibilities. So first off, directors have a duty to prepare financial statements, which must, number one, be prepared in accordance with applicable law and with generally accepted accounting practice in Ireland, and two, give a true and fair view of the state of affairs of the company and of its surplus or deficit for the year. Now, the duty to prepare financial statements is provided for in Section 148 of the Companies Act 1963, which is echoed by Section 17 of the MUD Act 2011, which requires that annual reports be prepared and furnished to each member. The reference to applicable law there refers to mainly the Companies Acts, but also to other laws and regulations that provide for additional disclosures, such as in the case of OMCs, we'll be looking at specifically the MUD Act and specifically Section 17 thereof, which prescribes various additional disclosures over and above those provided for in the Companies Acts. And the reference to generally accepted accounting practice in the first sub-bullet there refers to the accounting standards issued by the Financial Reporting Council and promulgated by the various accounting bodies affiliated to the CCAB, which is the consultative committee of accountancy bodies, which is basically an umbrella organisation for accountancy bodies in Ireland, comprising the Institute of Chartered Accountants or the Association of Certified Chartered Accountants or the Certified Public Accountants, and so on and so forth. It's worth noting, I suppose, when it comes to the reference there to generally accepted accounting practice, that effective from the 1st of January 2015, there'll be basically a new suite of accounting standards rolled out, which will supersede all existing Irish generally accepted accounting practice for about 95% of privately owned Irish companies. This is called FRS 102, and FRS 102 effectively evolved from a suite of accounting standards issued by the International Accounting Standards Boards called IFRS for SMEs, or International Financial Reporting Standards for SMEs. The FRC effectively adopted those accounting standards but tweaked them slightly just to allow for various nuances of Irish and UK law and various other departures where the FRC determined that existing Irish and UK accounting treatment is preferable to that proposed by the IASB. Second group of responsibilities then for the directors is in preparing the financial statements. They're required to select suitable accounting policies and apply them consistently. From time to time, accounting standards give the directors options in terms of what standard they may prefer to apply over another particular option. So the directors must choose, I suppose, the most suitable option and then apply that option consistently. Directors must also make judgments and estimates that are reasonable and prudent. They must prepare the financial statements on a going concern basis unless it's inappropriate to assume that the company will continue in business. And finally, the directors are responsible for keeping proper books of account, safeguarding the assets of the company, and for taking reasonable steps to prevent fraud and other irregularities. So you see I've highlighted just in the second sub-bullet, the first bullet up there, true and fair view, and in the second sub-bullet then, the third sub-bullet, going concern basis. So we'll have a look at those two phrases in a little bit more detail now. So what is meant by true and fair view? Well, it's not strictly defined in the legislation or accounting standards, so it's just something that's come about over time. It's understood to mean that the financial statements are free from material misstatement, material being the opportune word there, not necessarily free from misstatement, just free from material misstatement, and faithfully represents the financial performance and position of the company. True suggests that the financial statements are factually correct and have been prepared in accordance with generally accepted accounting practice in Ireland, and do not contain any material misstatements, errors or omissions that may mislead users. And fair implies that the financial statements present the information faithfully without any element of bias, and they reflect the economic substance of the transactions rather than just their legal form. So substance over form. Just going back to true there, where we say that the financial statements have been prepared in accordance with generally accepted accounting practice. That's not to say that that there can't be any departures from generally accepted accounting practice. There can be in circumstances where the departure would lead to a truer view than applying the accounting standard as fully documented. Moving on then to the going concern basis. So the going concern basis is dealt with in detail in ISA UK and Ireland 570, ISA being the International Standard of Auditing. So under the going concern basis, a company is viewed as continuing in business for the foreseeable future. So when the use of the going concern basis is appropriate, the assets and liabilities of the company are recorded on the basis that the company will be able to realise its assets and discharge its liabilities in the normal course of business. So the classic example there would be the likes of stock. I mean, you may have slow-moving stock, which you would hold at resale value on your or at cost on your balance sheet. Even though the stock is slow-moving, you'd expect to sell it all over a period of time, assuming that the financial statements are being prepared on a going concern basis. The alternative to the going concern basis is the breakup basis, which means that the expectation is that the company won't continue as a going concern for the foreseeable future, in which case you might be forced to dump all your stock onto the market at the same time. And in those circumstances, you're likely to recover full value for it. So if you're preparing your accounts on a breakup basis, you'd have to make adequate provisions and so on and so forth to reduce down the value of that stock to its fire sale valuation or breakup valuation. So you may have heard of the audit exemption. So what is it, and does my OMC qualify? And the answer is maybe, but probably not. And the reason is that most owner management companies are limited by guarantee companies, and limited by guarantee companies are specifically excluded from claiming audit exemption. So what is a limited by guarantee company? A limited by guarantee company is considered to be a public company. Therefore, it must have a minimum of 7 members. The liability of members is limited to the amount they've undertaken to contribute to the assets of the company in the event of its wind-up, not exceeding the amount specified in the Memorandum of Association, which is generally €1 to €5 in my experience. So each member is basically committed to paying over between €1 and €5 in the event that the company is wound up. So therein lies the limited liability. And the members are not required to buy shares in the company. Why? Because there is no share capital. Many charitable and professional bodies find this form of company to be a suitable vehicle as they wish to secure the benefits of separate legal personality and of limited liability, but don't require to raise funds from or make distributions to members. So the question then is, if there's no shares, how does one become a member of a company limited by guarantee? Well, basically, those that are qualified to become a member of a company limited by guarantee, the qualification criteria are generally set out in the company's memorandum of articles of association. So number one, you'd have to tick that box. And secondly, you'd have to be listed as a member on the company's official statutory register of members. So once you qualify as a member and once you're listed in the register of members, you're a member of the company. In the case of OMCs, it's generally written into the memo on arts that owners of individual units are entitled to be members, and those owners' names should then be written into the register of members of the OMCs in question. So you might be sitting there thinking, I'm no financial expert, or no expert in financial reporting matters. Am I really qualified to sit in the board of an OMC, given all the various responsibilities and so on and so forth to do with preparing accounts? And the answer is, of course, yes. The directors are perfectly entitled to outsource the OMC's day-to-day bookkeeping and preparation of its financial statements to suitably qualified third parties. And in the case of OMCs, they would tend to be managing agents such as the Dwyers. But the outsourcing of the directors' responsibilities in this regard doesn't abdicate them of their responsibilities. Directors would still be expected to provide a general level of oversight, and that would manifest itself, I suppose, in the following, is set out there in the sub-bullets. Selecting a suitably qualified and reputable managing agent, ensuring that proper books of account are kept by the managing agent, not just taking the managing agent's word for it, but actually, looking at those books and records every now and then. Monitoring service charge billing, cash receipts and outstanding debtors, and ensuring that suitable controls are in place over payments to suppliers. Again, the managing agent would generally take care of all that. The directors just need to make sure that they're satisfied that those controls and so on and so forth are in place. The controls over payments to suppliers typically maybe check signatories or limits on the level of checks that can be written, and so on and so forth. Scrutinising budget versus actual spend and inquiring into material variances. That would generally happen maybe quarterly and monthly at meetings with your managing agent, and inquiring about material judgments and estimates used in the financial statements and satisfying themselves that these are appropriate. Again, one of the director's responsibilities is to make material judgments and estimates. So if your managing agent is making those material judgments and estimates on your behalf, as a director, you're obliged to identify what those material judgments and estimates are, and satisfy yourselves that you're satisfied to make those or to stand over them. So that's it for the director's requirements. Fairly short and sweet. Next up then is the understanding the audit process. So again, I'll give a brief kind of high-level overview of what the auditor does, what's expected of the auditor, what the auditor actually does, give walk you around the kind of the audit process cycle, and we'll take it from there. Okay, so what does the scope of an audit comprise? Well, the auditor, basically to obtain evidence, it's to obtain sufficient appropriate audit evidence about the amounts and disclosures in the financial statements sufficient to give reasonable assurance that the financial statements are free from material misstatement, whether caused by fraud or error. So you'll note that the three key phrases highlighted there: obtain evidence, reasonable assurance, and material misstatement. I suppose the classic scenario there is the audit team sitting in a client's premises, kind of reading through the books and records, photocopying invoices, bank statements, and so on and so forth. And what they are doing is effectively they're obtaining sufficient and appropriate audit evidence about the amounts and disclosures in the financial statements to give reasonable assurance. And by reasonable, we're not striving for 100% assurance, for two reasons. Number one, 100% assurance is probably an impossible goal. It can't be done. And number two, it's certainly not economically feasible. It will require having to retest every transaction that the company made during the year, and independently verify every invoice, every sales invoice, every purchase invoice, every payment made, and so on and so forth. So we don't look for 100% assurance. We're going for reasonable assurance on foot of a risk-based approach, coupled with statistical sampling techniques designed to give us that reasonable assurance that the financial statements are free from material misstatement. And that's, again, just to reiterate, that's not to say that there won't be any misstatements, just that there be no material misstatements individually or in aggregate. So that's the first part of the scope of an audit. Secondly, then, the auditor assesses whether the accounting policies are appropriate to the company's circumstances, consistently applied and adequately disclosed. So they're the accounting policies that are selected by the directors. The auditors would assess those accounting policies and ensure that they are appropriate and consistently and adequately disclosed. They would assess the reasonableness of significant accounting estimates made by the directors. Again, in the case of OMCs, those estimates may well have been made by the managing agent, but the directors need to inform themselves of what estimates have been made because they will be standing over them. And then assess the overall presentation of the financial statements. So that just means reading the financial statements, ensuring all the necessary disclosures are made, and ensuring that there's no statements included in those financial statements which may materially alter or somehow bias the message that the financial statements should be giving compared to the message they actually are giving. And finally, then, the auditor reads the director's report to identify material inconsistencies with the audited financial statements and to identify any information that is materially incorrect or inconsistent with knowledge acquired in the course of performing an audit. And I suppose the reason this is done is because a lot of people, as you say, are not accountants. They may not necessarily understand financial reporting per se, but what they will do is they'll read the director's report. And if the director's report are saying something which clearly is inconsistent with how the numbers are stacking up further down the financial statements, then it's the auditor's duty to point that out. Just a word on the audit expectations gap. The audit expectations gap is the gap between the auditor's actual standard of performance and the various public expectations of an auditor's performance, as opposed to their required standard of performance. I've just set out here a list of examples of inaccurate expectations, and this list is by no means conclusive, but for the purposes of example, auditors should accept prime responsibility for the financial statements. Well, obviously this isn't true. The directors accept prime responsibility for the financial statements, and the auditors simply audit the financial statements within the bounds of materiality considerations. Auditors certify the financial statements. Again, not true. Auditors would tend to try and avoid certifying anything if they can. What we're doing is we're expressing an opinion as to whether or not those financial statements give a true and fair view, again within the bounds of materiality. Thirdly, a clean opinion guarantees the accuracy of financial statements. Again, not necessarily true. A clean opinion would certainly signify that the auditors are satisfied that there is no material misstatements in those financial statements. That's not necessary to say that they're entirely accurate, but that they're not materially misstated. The auditors perform a 100% check. Again, as we discussed, to perform a 100% check, particularly in larger companies, is just not economically viable, and you could never get there anyway. So what auditors do is they perform they generally adopt a risk-based approach to audits. They try and identify the risky areas where, you know, if a material misstatement was likely to or was going to occur, where is it most likely to occur. Focus testing on those areas, use statistical sampling tools, and so on and so forth, and arrive at a conclusion on that basis. So it's not a 100% check. It's a kind of a sample type of a check. Auditors should give early warning about the possibility of business failure. Again, very difficult to predict business failure. You can often have what would appear to be perfectly healthy companies, you know, failing mid-year for in respect of circumstance which just didn't exist at the year end. And what the auditors will do is that if a company is giving out signals that there may be potential business failure in there, the auditor may alter their audit report to kind of note that there may be what's called a going concern issue, and if the signals that the business is giving out are such that the going concern issue is likely to progress into a full-blown liquidation of the company. The auditors may disagree with the preparation of the financial statements on a going concern basis and qualify their report on that basis. But again, while we strive, to identify the early warning signals by the possibility of business failure, it's by no means an exact science. And the auditors are supposed to detect fraud. And I suppose, I guess it's a known fact that a well-executed fraud perpetrated by more than one individual acting in concert is almost impossible to detect, particularly with the procedures that the auditors use for assessing whether the financial statements give a true and fair view. So while we certainly do design our approach and our tests with fraud in mind, there's no guarantee that fraud will be detected. And I suppose it's often summarised with the following phrase, that the auditor is a watchdog and not necessarily a bloodhound. So moving on then to the audit process itself, the following slide constitutes a basic representation of the audit cycle. It's broken into 4 distinct parts. First up, we have our audit planning. So what we do in our office before we go out and hit the field. So that when we actually start our field work, that our testing is very focused and to the point. Next step then is field work, completion and reporting. So we'll just deal with each of them separately. First up, planning. So what we do here is agree the audit timetable. In the case of OMCs, we'd agree the audit timetable with Garrett and his team. When we'll receive the books and records, how long it'll take, when we expect to have the books and records back, and so on and so forth. Once we receive the financial records for audit from Garrett and his team, and once we've agreed a timetable, we then perform preliminary analytics. What we look at the current performance of the company compared to the prior year performance, and we'll compare the current performance of the company against its budget. Based on that, then we'll identify what we consider to be key risks. And obviously, wherever we identify a key risk, it'll obviously attract our attention in terms of where we focus our audit procedures. And finally, then we finalise our audit approach, we select our test procedures, and then we move into the fieldwork stage. So at fieldwork stage, this is when we're out kind of crunching the numbers, calculators out, tapping away, checking invoices, photocopying this, that, and the other. We're executing our test procedures, and we're gathering, retaining sufficient appropriate evidence to support audit conclusions. That's, I suppose, required of us by our institute and CARB. Any audit that we prepare, we have to retain a file backing up any conclusions that we may reach. So it can be kind of an onerous and drawn-out process, but unfortunately, it's something that we have to go through. Every thought process we have needs to be documented. Every piece of evidence that we're basing any major part of our opinion on needs to be copied and retained on file. We then move to the completion stage of the audit. This is where we review our audit findings and importantly, and probably most importantly, conclude on our key risks. If we've identified a risk as key at the start of the audit process, we're definitely expected to ensure that we conclude on those key risks at the end of the audit process. Then with having the benefit of hindsight, having then done our preliminary analytics and our field work, we're then in a position to reassess whether the accounting policies that the directors have chosen to use were appropriate. So we formally do that and we document that on our file. We then, of course, review the financial statements, because that's ultimately what we're signing off on. And we finalise our audit opinion. Once this is all done, we move to the reporting stage, where we prepare our audit report, and we prepare our management letter, and we prepare other reports as necessary. And we'll come to those other reports now in a few minutes. So effectively, our product as an auditor is one page in the financial statements of a company, which is the audit report. And we stand over that opinion by actually physically signing that report in the financial statements. So that's just a brief overview of then the audit process for an OMC. So I mentioned there that as part of our planning process and as part of our completion process, we give significant time to identifying and concluding on key risks. So I suppose it'd be good to just have a look at the traditional or key risks for an OMC. And I suppose I just point out that these are key audit risks. There are other risks as well for an auditor, which I'll come to now in a few minutes. So first off then, revenue recognition. Well, revenue recognition is always a key risk, regardless of the industry, regardless of the company, regardless of anything. Revenue recognition is always the first key risk down on an auditor's key risk matrix. And I suppose from an OMC point of view, what we're interested in ensuring is that the OMC only recognises income that it is irrevocably entitled to collect from members, and only that income. And in doing that, I suppose what we would tend to do is have a look at the service charge budget that was approved by the members at the previous AGM and compare that to the actual billing. And if the two aren't the same, then we'd look into where the variances came from and why they're not the same. In 95% of the cases they're the same, so there's generally no issue there. Another issue then is the treatment of late payment interest and legal fee recoveries. And this can be a bit of a tricky one, and various managing agents have different views as to how these should be treated. But I suppose, unless interest and legal fee recoveries are specifically referenced in members' leases, arrears of this nature are treated as simple contract debt by courts. And there's no guarantee that judgments in favour of the OMC, should judgments be sought in the courts, there's no guarantee that these judgments will include interest and legal fee recoveries. So that begs the question, should they be recognised as income as they're charged up on members' accounts, or should they be recognised as income when they're actually received? The next key risk after revenue recognition, typically for an OMC, is the recoverability of service charge debtors themselves. In particular from developers that may no longer be solvent if developers are still involved in the company and the common areas haven't yet been handed over. What we look at there then is the adequacy of the provision for bad debts. Obviously if somebody owes the OMC money, the OMC isn't going to write that off without a fight. But what they should be doing is if the chances are that money is not recoverable, they should be providing for it. So we'd have a look there at the list of outstanding debtors from members and from developers, and trying, based on whatever audit evidence is available to us, to decide whether the carrying value or reported value of the amount actually receivable is actually recoverable. The next thing we'd have to consider is the internal control environment of the OMC, and by that we mean the internal control environment of the managing agent. The managing agent would generally tend to manage the finances of multiple OMCs, and good managing agents would provide strong internal control environment. So what will come into our consideration would be the competence of the managing agent, and also, as we spoke previously about, the level of director oversight. We would review as part of our work the minutes of the meetings between the managing agent and the directors, and we'd be interested in ensuring that the directors meet regularly with the managing agent, and that they're discussing, relevant matters such as the likes of service charge receivables, having detailed discussions on budget versus actual expenditure, and so on and so forth. And that gives us comfort that the directors are actually providing a level of oversight. Another key risk then is disclosures in relation to related party transactions, and specifically the status of the developer. The developer for most OMCs is the related party, generally the only related party. And if the developer has not yet handed over the common areas, then any transaction, the developer is treated as a related party, and any transactions with the developer should be disclosed. And by that we mean any contribution that the developer has agreed to make to the company during the period, and any amounts owing by the developer at the end of the period. I suppose the second last key risk then would be estimates and judgments. Not necessarily always relevant. You'd see it in cases where the OMC is maybe involved in legal actions. I've seen a couple of cases where OMCs are actually defending actions against members for various disputes and have had to provide for the cost of those disputes and any settlement amounts and so on and so forth. So how much do you provide for? How long is a piece of string? Difficult to know. So again, all we can do is have a look and see what evidence is available and ensure that that any estimates made in this regard are reasonable. And then for OMCs, I suppose the last key audit risk is just to ensure that all the various disclosure requirements of Section 17 of the MUD Act are all present and correct in the financial statements. And I suppose, as I mentioned before, these are the key audit risks for OMCs. I mean, there's another risk as well from an auditor's perspective, specifically pertaining to OMCs, and that is the members themselves. OMCs can have hundreds of members, all of whom are entitled to scrutinise the financial statements, which effectively gives the OMC a risk profile similar to those of a fully fledged and publicly traded PLC. Which is quite a risk exposure. So that is always in the back of the auditor's mind when auditing these sets of financial statements. Okay, so next up is the auditor's principal reporting responsibilities. So I suppose the auditor has two types of reporting responsibilities. There's the principal responsibilities, which you'll see in the audit report and the financial statements, and there's other additional responsibilities which are a little bit more onerous. And we'll come to those in a second. So first off then, statutory responsibility to report to the OMC's members an opinion as to whether the financial statements give a true and fair view in accordance with GAAP and are properly prepared in accordance with the Companies Acts 1963 or to 2013. We also have to report whether or not the OMC has kept proper books of account. And we have to report whether the director's report is consistent with the financial statements. Secondly, we have to state whether all the information and explanations considered necessary for the purposes of the audit were obtained and whether the financial statements are in agreement with the books of account. And finally, we have to report if any information specified by law regarding directors' remuneration and directors' transactions is not given, and where it is not given, we must provide such information in our audit report. That third point is not so relevant to OMCs because by and large directors don't receive any remuneration and the directors by and large don't enter into transactions with the OMC. With the exception of directors of OMCs who may be connected in some way with the developer, in which case those transactions are given in a related party note as we discussed previously. Our other additional reporting responsibilities are a little bit more onerous, and I suppose this is where it gets a bit more serious. So where an indictable offence under the Companies Act has been committed by an OMC in relation to the affairs of an OMC by an officer, employee or agent of the OMC, then we are required to notify the Office of Director of Corporate Enforcement of this offence. Where proper books of account are not being kept by the OMC, we have to serve notice on the OMC, and if no steps are taken within 7 days of the receipt of this notice to ensure the proper books of account are kept, we have to notify the Registrar of Companies, who will in turn notify the Office of Director of Corporate Enforcement. Where an offence under the Criminal Justice Theft and Fraud Offences Act 2001 or the Criminal Justice Terrorist Offences Act 2005 has been committed, we have to notify the Garda Síochána and the ODCE. Where an offence under the Criminal Justice Money Laundering and Terrorist Financing Act has been committed or in relation to the affairs, has been committed by the OMC or in relation to its affairs by an officer, employee or agent, again we have to notify the Garda Síochána and this time the Revenue Commissioners. And finally, where an offence under the Taxes Consolidation Act 97 has been committed in relation to the affairs of the OMC, we have to serve notice on the directors to rectify the matter, or if the matter is not rectified, we have to notify the Revenue Commissioners within 6 months, cease to act as auditor, and notify the Revenue Commissioners within 14 days of ceasing to act as auditor. So it's all quite onerous and it can get quite cantankerous, and luckily enough it doesn't happen very often. So that's it for the kind of an insight into the audit approach and what goes through an auditor's mind when he or she is performing the audit of a set of financial statements of an OMC. So finally we get into then reading the financial reports of OMCs. So the good news is that a typical set of OMC financial statements is quite straightforward and basic and runs to around about 11 to 13 pages, thereabouts, depending on how they're laid out. They would typically include a director's and other info page, a director's report, a statement of director's responsibilities, which is sometimes included within the director's report, but more often than not set out as a separate primary statement, an auditor's report, an income and expenditure account, a balance sheet, a cash flow statement, a statement of accounting policies, and the notes to the financial statements. Just from the director's perspective, I suppose the directors are specifically standing over the director's report, which they sign, the statement of director's responsibilities, which they also sign, the income and expenditure account, which they sign, and the balance sheet, which they sign. So let's just have a look at each of these in a little bit more detail. The directors and other information page, that would just set out the names of the directors and the company secretary and the dates of their appointment or resignation, if that appointment or resignation occurred during the period. The company number is listed, the address of the registered office of the company, the name of the auditor, the name of the solicitor, if there is a solicitor appointed to the company, the name of the banker, and the name of the managing agent. So it's just a very factual page. Next up is the director's report. And the director's report, I suppose, contains much of the additional disclosures required by the MUD Act over and above those that are required by the Companies Acts. So what I've done as we're going down through it, if it's specifically a MUD Act disclosure requirement, I've just put in the words MUD Act behind it there on the bullet point. So firstly, the details of the principal activity of the company. And in the case of OMCs, it's generally something along the lines of to manage the common areas of whatever the name of the development is, and so on and so forth. The principal risks and uncertainties of the OMC, and again they tend to be consistent from OMC to OMC. Principal risk is sustainability of cash flows and the ability of the company to collect service charges owed by members, because effectively without the service charges being collected, the company can't discharge its costs. The amount of the annual service charge is specifically disclosed in the Director's Report, as required by the MUD Act. Details of any planned building investment works. So this would be to give the readers of the financial statements an idea as to how their sinking fund may be expended at some stage in the near future. The insured value of the development, together with the name of the insurer, the premium charged, and the risks covered. That can be quite a detailed note. Also, details of fire safety equipment and arrangements for maintenance of same need to be included. The surplus or deficit for the period needs to be referenced. It's literally just sort of a one-liner kind of noting what the surplus deficit is. It's a Companies Act requirement. State the report requirements of the Companies Amendment Act 1986 do not apply because it's a company limited by guarantee. What this means here is that companies which are limited by shares have certain benefits that they can take advantage of in terms of reporting. You know, if the company is a small company, they can produce bridged financial statements, and they've got a less onerous filing requirement and so on and so forth. None of these apply to a company limited by guarantee because it can't be regarded as small, medium or large. It just is what it is, and it has to make a full filing. Names of directors retiring by rotation if appropriate. Generally speaking, the default mode for directors retiring by rotation will be Table A of the Table A of the appendix or the schedule to the 63 Act, which would require that 1/3 of the directors retire by rotation, every year. And a lot of OMCs have that requirement, but it's not necessary to say that the memo and articles could change that and require that they, retire once every year, retire. The full board may be required to retire, or nobody may be required to retire. In any case, the MUD Act has a specific kind of provision that no director can stay in place for a period of longer than 3 years. So the director's report would generally just have a note included in there. It's kind of specifying the retirement arrangements for the directors. It also sets out details of the directors' and secretaries' interests in the company. Again, this doesn't tend to be a long note because the companies tend to be limited by guarantee. The directors really, if the directors are members, they tend to have no interest other than their interest as a member, and that would be noted. So there's not a whole pile to say there. And then details of steps taken by the directors to ensure proper books of account are maintained. And here it'll be noted that the bookkeeping has been outsourced to the managing agent, and the managing agent has employed competent personnel and so on and so forth, and used a suite of suitable controls. And then it'll also state where the books of account are maintained, which is generally in the office of the managing agent. So that's it for the director's report. The statement of director's responsibilities actually is sometimes included within the director's report, but more often than not it's a separate statement and signed separately by directors. And this is just the directors formally acknowledging their responsibility for the preparation of the financial statements, the selection of suitable accounting policies, the making of judgments and estimates, the use of the going concern concept, and the keeping of proper books, lest anybody be in any doubt. The auditor's report is next up, and that is basically broken down into a number of sections. 1, 2, 3, 4, 5, 6 sections. Now, the layout of the auditor's report recently changed with a change in international standards in auditing. So previously the auditor's report was a kind of a long kind of page and a half drawn out affair, broken into 3 sections. So now it's kind of distilled down into a one-pager, presuming a clean opinion is given, and it's broken into 5 distinct sections. So the first part is your tends to be your introduction and your bannerman, or what's known as your bannerman paragraph. And that bannerman paragraph, just a reiteration, I suppose, that the report is made solely to the members, and that the report includes matters that the auditor is required to state to the auditor's report, and for no other purpose, and that the auditor accepts or assumes no responsibility to anyone else other than the members and the company for their audit report. So it just makes people aware, anybody who may be relying on the auditor's report, just makes them aware that the auditor accepts no duty of care to anybody except the company and the members. So that's generally included in the first part of the audit report. The second part just lays out again, so that there's no misunderstandings, the responsibilities of the directors and the auditors. Generally what it does is it refers back to the statement of directors' responsibilities to point out that this is what the directors are responsible for, and then it simply says that the auditor is responsible for auditing the financial statements. The next part kind of lays out the scope of the audit. Again, we talked about this earlier. I just have a sample audit report in my hand here just for reference, but again it's just obtaining evidence of the amounts and disclosures in the financial statements, ensuring accounting policies are appropriate, checking the reasonableness of significant estimates, ensuring the presentation is appropriate, and reading the director's report and so on and so forth. So it kind of sets out the scope of the audit again in that one paragraph in the audit report. The next up we have the opinion on the financial statements. So this is where the auditor basically states in plain English whether or not the financial statements give a true and fair view in accordance with generally accepted accounting practice of the state of affairs of the company, or whether it doesn't. It's very rare that it doesn't. In 99% of the cases it does. And secondly, under that opinion paragraph, it states whether or not the financial statements are prepared in accordance with the Companies Acts 1963 to 2013. The next part of the audit report then is matters in which we are required to report by the Companies Acts 1963 to 2013. So these are not required by international standards on auditing, just simply by the Companies Acts, and they're very specific matters. The first matter is whether or not we've obtained all information and explanations which we consider necessary. The second matter is whether, in our opinion, proper books of account have been kept. Thirdly, whether, in our opinion, the financial statements are in agreement with those books of account. And fourthly, in our opinion, whether the information given in the Director's report is consistent with the financial statements. So we've discussed all this previously. There's generally speaking, there's a fifth requirement in there as well, but it doesn't apply to companies limited by guarantee, and that's to do with whether or not whether a financial situation exists, which may require the convening of an EGM. But that doesn't apply to companies limited by guarantee because they have no share capital, and therefore they can't have a financial statement can't exist, or a financial situation can't exist. And then finally, we have to deal with matters on which we're required to report by exception, and that basically deals with whether requires us to report if, in our opinion, the disclosures of directors' remuneration and transactions specified by law are not made. And if they're not made, this is where we make those disclosures in our audit report. Next up, then, the income and expenditure account. So this is the statement of income and expenditure, literally income positive, expenditure minus, leaving a surplus or deficit for the year. The balance sheet then is just a statement of the assets and liabilities of the company at the period end and comparative period end. And underneath that, then, that's balanced off by a statement of the reserves of the company, which would include the sinking fund at the period end and the comparative period end. And I suppose the thing to note here is that the balance sheet of owners' management companies tend to be fairly working capital type of balance sheet in practice, insofar as that it would comprise of maybe debtors, cash and creditors, nothing else. Very rarely would you see fixed assets or anything, at least at this stage, on the balance sheet of an owner's management company. The cash flow statement then is next up, and that sort of sets out the operating and other cash flows for the period. Again, because the company can't take advantage of the disclosure requirements, because owner's management company may be limited by guarantee, it doesn't get to avail of the cash flow statement exemption, which it might otherwise be able to avail of as a small company, and therefore it must include a cash flow statement. And that cash flow statement will effectively reconcile the opening cash balance at the start of the period to the closing cash balance at the end of the period. Then we have the statement of accounting policies. So it's very simple. It's just literally a statement of all the key accounting policies that the owner's management company is following. It tends to be quite brief because there's no major complicated accounting policies involved in these companies. Then we have the income and expenditure notes. The income, we have generally include a detailed breakdown of service charge by unit type, which is required by the MUD Act. And then we have various statutory disclosures. Typically for an owner's management company, the auditor's fee gets disclosed in there. If there's any interest receivable, then we just disclose where that, the source of that interest, whether it's bank interest or other type of interest or whatever it is. And then we have a note on the company's tax exposures and a reconciliation of the tax charge. Just a quick word in taxation. Obviously, owners' management companies, they don't pay tax, and the reason they don't pay tax is that they are considered to be a mutual trading organisation. And as a result, they're exempt from tax. So if we just see the note there, if a group of people join together for a common purpose, their transactions with the umbrella group are considered to be a mutual trade. So in the case of OMCs, the directors are considered, or the members are considered to be the group of people joining together for a common purpose. And the income of the OMC from service charges received from its members are considered to be a mutual trade, and therefore they're exempt from tax. Having said that, other income, such as the deposit interest, are not exempt from tax because they don't derive from that mutual trade. So occasionally you may see a small amount of corporation tax on the financial statements of an OMC, but it won't be from the service charges received from the members. It'll literally be from something like deposit interest or something like that, which falls outside the mutual trade. Next up, we have the debtor's note and the creditor's note. Again, it just lists down for the current period and the comparative period each class of debtor. Principally, service charges owed by members, contributions owed by developers, prepaid expenses in the case of the debtor side. The debtor's note might also disclose the number of units in respect of which service charges remain outstanding. Creditor side, again, period end and comparative period end. For each class of creditor, the balance owed in respect of trade creditors, service charges prepaid by members. Sometimes it does happen. And effectively those service charges are owed back to the members until such time as the company is entitled irrevocably to claim those service charges, and then accrued expenses. Finally, we have the reserves notes. Typically in an OMC, there's two classes of reserves. There's your income and expenditure reserve and your sinking fund. And the reserves note effectively reconciles the opening reserves to the closing reserves by class of reserve. And the reconciling items are generally the surplus or deficit for the period, and then sometimes there may be transfers between reserves, maybe a transfer from the income and expenditure reserve to the sinking fund, or back again, depending on what way the members voted at an AGM. Also included with this note is a disclosure of the amount standing to the credit of the sinking fund, which is required by the MUD Act. Now, it's quite obvious if you look at the table that's on the note that it's what it is, but it's also generally separately declared as well, as it's required to be declared by the MUD Act. And then details of the annual contribution to the sinking fund and the basis of this calculation, which is generally that this is what the members agreed to contribute at the AGM. We then have the reconciliation of movements in the members' funds and deficit, which is similar to the reserves note. Again, a similar type of reconciliation. Up next, then, the related party transactions note. Again, we generally tend to see this where the developer hasn't yet handed over the common areas of the company. And this note, we state the nature of the relationship with the related party. We kind of have to know why is this person or entity related to the company and how is it related. We set out the details of the transactions entered into with the related party for the period and the comparative period. Any details of outstanding and the details of any outstanding balances at the period end, either owing to or from the company. And for the comparative period end as well. And as I say there, typically the developer is the related party until the common areas are handed over in the case of OMCs. And finally then, we've a note on the capital structure of the company, where we state the number of members and the limit of each member's liability in the event of wind-up. And again, as we mentioned previously, that the limit of each member's liability is generally somewhere between €1 and €5 in my experience. So that's it, and just apologies there, I kind of ran over a little bit longer than I was expecting. But I'll take questions now if there's any.
Just one thing that you looked at, Dave, when you're looking at the balance sheet,
yeah,
in particular, there seems to be a bit of confusion out there between the difference between the reserve and, particularly for the sinking fund reserve versus the cash balances.
Yes, yeah.
So can you just run through how the reserve is made up as opposed to the cash, versus the cash balance in the sinking fund?
Right. Okay. So is this the situation whereby where there might be no ring-fenced bank account for the sinking fund? Is it?
Yeah. So say you may have a reserve built up over years, but the bank balance doesn't
necessarily agree to it. Yeah. Yeah. Okay. Well, I suppose what some companies are doing now is that they're actually creating a specific bank account. A deposit account called a sinking fund account, and they're actually trying to match the amount in their sinking fund reserve with the amount in that particular bank account, just to have it there in cash money, ring fenced away, and ready to be drawn down if needed. But they don't necessarily have to do that. As we explained earlier, the sinking fund is kind of like to a certain extent, it's a notional concept. If you think of the makeup of the balance sheet of a management company, if you think of the two halves, so the top half of it is made up of debtors, which are amounts owing by the members to the company, by the members and the developer, actual cash in the bank, and then creditors, which are amounts owing by the company out to its various suppliers and so on and so forth. And if the company's debtors exceed its creditors, you have what's known as net assets, and those net assets are reasonably liquid in nature for management companies because they don't have any fixed assets or any of those long-term type of assets like that. So technically speaking, that could be converted into cash fairly quickly if you wanted to exit that position. So what the bottom half of the balance sheet does then is it says that, well, we take these net assets, which are fairly liquid net assets, and we split them between what we call an income and expenditure reserve and a sinking fund. And while the amount in the bank account doesn't necessarily exactly equal what's included in the sinking fund, because of the fairly liquid nature of the net assets, it probably could be, if needed. And what a lot of management companies are doing is that they're trying to move to that position over time, where they sort of set up a deposit account and they try and shift cash over to it and ring fence it over time to try and make the two of them equal. It can't be done, I suppose, straight off, because the company has obligations and not everybody pays their service charges on time and so on and so forth. But again, that's the thinking behind it, if that answers your question. Yeah.
One other thing that the financial statements, preparation of them is, as you said, the responsibility of the directors, but in most cases that's passed on to the managing agents.
Correct, yes, yeah.
So what kind of sanction would there be for directors if the accounts don't give a true and fair view? So obviously they're not involved on a day-to-day basis.
Well, basically the full weight of the law bears down on the directors. It's their responsibility, to ensure that where these responsibilities have been outsourced, for want of a better word, to third parties. As we say, that doesn't relieve them of their duties. They would still be required to have, a general level of oversight and be able to demonstrate to any authorities that may be reviewing their behaviour in this regard, that they did all that was humanly possible, and taking into account that maybe they mightn't be financially minded people, or they might not be accountants or whatever, but that they did all that could be reasonably be expected of them, in the circumstances to undertake their duties as required by the law. Yeah. Yeah.
David, when you still talk about material misstatements,
Sure, yeah.
What do you mean by the word material as against misstatements?
Material is, again, it's one of those how long's a piece of string questions, right? But what it is generally understood to mean is that amount which, if the financial statements were restated, would influence decisions made by the users of those financial statements. So if you take, let's say, a company with a turnover of 100 million euros and net assets of 50 million euros, and there was a misstatement in there of 50,000 euros, that might necessarily influence the investment decisions of people investing in that company or any other users of those financial statements. But if that same 50,000 misstatement was applied to a company with a turnover of 2 million or 1 million, that would be considered to be very, very material. Yeah.
Irrelevant really in the bigger picture.
Exactly, yeah.
Sorry, I just wanted to...
Yeah, go for it.
Just in relation to the name of the solicitor in the financial report, is
Yeah.
that necessary? Is it,
No, not necessary.
I just came up with another outside of this scenario.
No, I mean, if the company hasn't engaged a solicitor, to look after its legal affairs, then you don't have to name a solicitor. No.
And the other thing, just in relation to what's included in the accounts and what's not included,
Sure, yeah.
talking about including recognising income or legal fees, late payments and interest.
Yes, yeah.
Were you saying there that it depends again on the circumstances whether they're included in the financial statements or not?
What I was saying there is that the OMC is only entitled to recognise income which it is irrevocably entitled to collect. So the question mark is the OMC irrevocably entitled to collect legal fees and interest levied on members' accounts? And there's a question mark over it because it is treated as a simple debt, by the courts. And the courts, when you go to the courts and you can say, member A owes us, backdated service charges of 15,000 plus, 3,000 euros worth of interest and penalties and so on and so forth. The courts might only award you a judgment for the amount that they actually owed. So the question mark there as to whether, certainly levy the amounts on their statements and so on and so forth, and they should know that they owe these amounts. But the question then is that does the OMC actually recognise that income or not?
Just one final question, sorry.
Go for it, Jay.
I'm sorry, it isn't relevant necessarily to where I represent here, but a lot of developers now are getting in trouble saying either through non-payment of charges because of condition of their apartments and so on.
Yeah.
Right? Where money isn't coming in and these units need attention or commonly need attention. What happens in a situation like that? I mean, where the thing isn't really solved, and but still people are living in these apartments. Yeah.
It's a tricky situation, and I suppose it's something that's sitting out there waiting to happen. And there's a lot of people looking at it and sort of saying, well, what's going to happen here? Because theoretically speaking, there is a material uncertainty over the company's ability to continue with the going concern if, in fact, it can't collect any of its service charge debtors and it can't discharge its creditors as they fall due. But how could you liquidate this company because other people are still paying their service charges and they're needed? The company is needed in order to contingent service to development. So it's difficult to know what to do there. It may be that, and I'm only speculating, and I don't know. It may be that maybe the company might actually fold, and another company might need to be set up specifically to deal with the members who are actually paying, and some part of the development might have to be discarded. I suppose it's more of a legal question than an accounting question per se. But from an auditor's point of view, there would certainly be a question mark over, is the going concern concept relevant, in this instance. Yeah. Yeah. Okay. Thank you very much. I think we can call it a day now.